McGilla Golf has decided to sell a new line of golf clubs. The clubs will sell for $665 per set and have a variable cost of $340 per set. The company has spent $150,000 for a marketing study that determined the company will sell 70,000 sets per year for 7 years. The marketing study also determined that the company will lose sales of 9,000 sets per year of its high-priced clubs. The high-priced clubs sell at $1,100 and have variable cost of $550. The company will also increase sales of its cheap clubs by 12,000 sets per year. The cheap clubs sell for $300 and have variable cost of $100 per set. The fixed costs each year will be $10,800,000. The company has also spent $1 million on research and development for the new clubs. The plant and equipment required will cost $19.8 million and will be depreciated on a straight line basis. The new clubs will also require an increase in net working capital of $1.5 million that will be returned at the end of the project. The tax rate is 40% and the cost of capital is 14%. Calculate the payback period, the NPV and the IRR. First, let's determine the initial cost. And we need to recognize that the R&D and the marketing cost are both sunk costs, and so those get ignored. With project analysis and capital budgeting, we're interested in the incremental costs going forward. So we need to consider the $19.8 million that we've spent plus the $1.5 million, and that gives us an initial cost of $21.3 million. Next, we need to determine the incremental sales and incremental costs. So the problem tells us that the new clubs, which will sell for $675 per set, the problem tells us we'll sell 70,000 of those, so that comes out to be $47,250,000. But we will also substitute some sales or cannibalize some sales of existing clubs, and we will then also have some incremental sales of the cheap clubs, and that comes out to be $3.6 million. So when we add up the incremental sales and also reduce the substituted or cannibalized sales, we see that sales will come out to be $40,950,000. Now next we have to determine the variable costs. So using the information, 70,000 times $340 of variable cost for the new clubs comes out to be $23.8 million. We save the variable cost of the substituted clubs, and those cost $550. We're going to lose 9,000 units, so we save $4.95 million of variable costs. And the cheap clubs cost us $100 per set. 12,000 sets are expected to be sold, so that costs us $1.2 million. We add all those together and we come up with $20.05 million of variable costs. Okay, next we can put together the income statement, or the pro forma income statement, as a result of the information we've provided so far. So we jot down sales, variable costs, other costs, right, the fixed cost. We determine what the depreciation will be and drop that in, and we come up with earnings before taxes. Then we deduct taxes to come up with net income. Once we have the pro forma income statement put together, we can calculate the operating cash flow, which is equal to net income plus depreciation. So we add those two together, and the operating cash flows are then $7,191,429. Next, you see how we determine payback. And the way I like to approach this is just to compute the cumulative cash flows in a column next to the cash flows. So we start off with the initial capital expenditures or cash outflows that were required, and then we jot in what the operating cash flows would be. And once we can see that the cumulative cash flow will turn positive, we do the division to determine how much of the partial year needs to be included to determine payback. And in this one you see that payback is equal to 2 plus 6.9 million divided by 7.2 million, that's rounded, to come up with payback of 2.96 years. Now I'll illustrate how to come up with NPV and internal rate of return. Now you're going to get a video that appears on the screen. Please note that you can mouse over to the bottom and you will see the video controls, the playback bar, and then when you mouse off of it, it will disappear. So use that to control the volume, and if you want to start and stop it again. Here is the final solution that calculates NPV and internal rate of return. So what you see is I've jotted in the cash flows from all the years, right? The 21,300,000 is the initial cash outlay. Then we jot in the cash flows that would be incoming. And keep in mind that in the last year, let me hit the F2 and show you that we have the initial or the projected cash or projected operating cash flow, but then we have to add in the working capital, the $1.5 million that we're expecting to be returned at the end of the project. The cost of capital is 14%, and then we have the NPV, and let me show you how I calculated that. Best way is probably just to recalculate it. So we'll type equal NPV, hit left paren, and hit the insert function bar so we get the pop-up. Okay, the rate is the 14% given there, and then the values we need to start, let me move this out of the way, start at the end of the first period and go to the end. But then once we bring that down, we're not quite done with our function, so I'll hit OK, but we also need to hit F2 and add in the initial cash outlay. And when we do that, we get the $10,138,000 in spare change. That's NPV. Now for internal rate of return, we just simply type in the values and jot in a guess, and I've used 10%. Then you hit the OK, and you come up with the value that you see there. And that's how we solve this problem.